Right now, someone is driving off a dealership lot in a car that will cost them everything. Someone else just split their grocery bill into 4 payments because the math stopped working. And somewhere, tens of thousands of dollars are sitting in a bank account, quietly losing value while inflation does its job. The numbers I'm walking you through today come from the Federal Reserve, the Consumer Financial Protection Bureau, major banks, and financial research firms. They track behavior, not intentions, and the picture they paint is uncomfortable, eye-opening, and in some cases, genuinely hard to believe. Let's start with something sitting in almost every American driveway. According to Edmunds Q4 2025 data, 29.3% of car trade-ins toward new vehicle purchases are currently underwater, the highest rate since the pandemic disruptions of 2021. Being underwater means you owe more on your loan than the car is worth. And when you go to trade it in, that debt doesn't disappear. It follows you. The average negative equity hit an all-time record of $7,214 in late 2025, with more than 1 in 4 underwater trade-ins carrying over $10,000 in negative equity. The trap compounds fast. Buyers who rolled that debt into new loans paid an average of $916 a month, and 40.7% stretched into 84-month terms just to make it feel manageable. 3 things break this cycle: buy used, put at least 20% down, and keep your loan under 48 months. The second statistic reveals how Americans are financing their everyday lives, and it's gotten stranger than most people realize. Buy now, pay later services started as a way to split big purchases. They've become something else entirely. According to LendingTree's February 2026 tracker, 41% of BNPL users missed at least 1 payment in the past year, up from 34% just 12 months earlier. But the real story is what people are actually financing with these services. A quarter of BNPL users are now splitting their grocery bills into installments, nearly double the rate from a year ago. Gen Z leads that trend, with 33% using buy now, pay later at the supermarket, and 71% carrying multiple BNPL loans at the same time. The psychology is simple. Spreading payments out makes spending feel less real, but the consequences are real enough. Nearly 60% of users have financed things they couldn't actually afford. 26% regretted it once the full cost hit, and 62% falsely believe on-time BNPL payments are building their credit score. Most services don't report positive payment history to credit bureaus at all. They only show up when an account goes to collections. The third statistic is about money sitting idle, and it's costing people far more than they realize. The national average savings account interest rate sits at 0.39% as of early 2026. High-yield savings accounts at online banks are routinely offering 4% or higher. That's a tenfold difference for the exact same behavior, keeping money in a savings account. On a $10,000 balance, that's the difference between earning $39 a year and earning $400. On $50,000, it's $195 versus $2,000, with 0 additional risk and 0 change in behavior beyond opening a different account. The Federal Reserve cut rates 3 times in late 2025, bringing the target range to 3.5 to 3.75%. So high-yield rates have softened slightly, but they still dwarf what most Americans are actually earning. The fix takes minutes to set up and days to transfer. Every month you leave money in a traditional savings account earning next to nothing is money you're voluntarily leaving behind. The fourth statistic exposes just how fragile most American households actually are. According to Bankrate, 60% of Americans could not cover a $1,000 emergency expense from their savings. 1 in 4 would reach for a credit card to handle it. What makes this particularly striking is that this number hasn't meaningfully changed in years. The economy shifts, wages move, headlines change, and yet most Americans remain 1 car repair or medical bill away from financial stress. The generational breakdown adds context. 34% of Gen Z has no emergency savings at all, and roughly a third of every generation has some savings but not enough to cover 3 months of expenses. Financial experts have recommended a 3 to 6 month emergency fund for decades. The gap between that recommendation and reality has persisted through good economies and bad ones alike. The solution isn't complicated. It's treating emergency savings as non-negotiable, rather than something you'll get to eventually. Getting from $0 to $1,000 changes your financial reality more than any percentage increase above that threshold ever will. The fifth statistic puts all of this in perspective. According to Bankrate data, the median bank account balance in the United States is approximately $8,000. That's the midpoint. Half of all Americans have less than that accessible at any given time. The breakdown by income tells the more interesting story. Households earning $153,000 or more carry a median balance of $33,800. Households earning between $35,000 and $50,000 sit closer to $3,000. Income drives savings capacity more than any other single factor, and the raw math makes that obvious. Someone earning $40,000 saving 15% accumulates $6,000 a year, while someone earning $150,000 at the same savings rate puts away $22,500. That gap widens every single year. The important perspective shift here is this. Comparing yourself to the overall median without accounting for income tells you very little. Someone with $25,000 saved on a $60,000 salary is in a completely different position than someone with $25,000 saved on $180,000. For lower earners, building wealth isn't impossible. It just requires more time, more discipline, and a serious focus on growing income alongside controlling expenses. The sixth statistic reveals a mistake that quietly costs people enormous sums over decades. According to Vanguard research, 28% of people who roll money from a 401k into an IRA leave that money sitting in cash, uninvested, earning almost nothing. The psychology behind it makes sense. Contributing to a retirement account feels like investing. The rollover completed, the money is in the account, it feels like everything is working. But an IRA is just a container. The money inside it can sit in cash going nowhere, or it can be invested in funds that grow over time. According to a CNBC report, 68% of people don't even know how their retirement assets are actually invested. The financial institution receiving the rollover doesn't automatically put that money to work. The account holder has to make an active decision. Someone who rolled over $100,000 in 2020 and left it in cash has roughly $100,000 today. Someone who invested that same amount in a broad market index fund has substantially more. The fix takes 5 minutes. Log into your IRA, check what the money is actually held in, and if it says cash, money market, or settlement fund, make a decision about where it should actually go. The seventh statistic provides crucial context for anyone invested in the stock market. Historically, the market has doubled roughly every 10 years. Not a guarantee, but the long-term average annual return of 8 to 10% compounds to approximately that over time. What most investors struggle with is the volatility along the way. According to Financial Samurai analysis, 38% of years since 1930 saw the S&P 500 fall between 10 and 20% at some point during the year. Another 16% of years saw drops exceeding 20%. Corrections aren't exceptions, they're part of the process, and the cost of trying to avoid that discomfort is severe. Miss just the 10 best market days over the past 30 years and you erase roughly 54% of your potential gains. Miss 20 and you lose 73%. Miss 30 and 83% of your gains are gone. The problem is that the best days tend to cluster around the most volatile periods. Investors who sell during downturns and wait for things to feel stable before getting back in consistently miss the rebounds that generate the majority of long-term returns. The market doesn't reward perfect timing. It rewards time spent in the market. The eighth statistic documents a generational shift in homeownership that's reshaping how Americans think about one of the most fundamental financial milestones. According to the National Association of Realtors 2025 data, the median age of first-time homebuyers reached 40 years old, while the share of first-time buyers dropped to just 21% of all purchases, a record low. Other researchers, using different methodologies, put the median age closer to 33 or 34. But regardless of which number you use, the direction is the same. First-time buyer ages have climbed significantly since the late 1990s and early 2000s, and the share of first-timers in the market has contracted sharply since before the 2008 financial crisis. Median home prices have outpaced median incomes for decades. Mortgage rates, while below their 2023 peaks, remain elevated compared to the historic lows of 2020 and 2021. The income now required to comfortably afford a median-priced home exceeds $140,000 annually in many analyses. The traditional path to homeownership still exists, but the requirements have intensified dramatically. For most young buyers today, the options are earning more, saving longer, relocating to more affordable markets, or simply accepting a longer timeline than their parents faced. The ninth statistic defines what it actually takes to reach the top 10% of American households. According to Federal Reserve data, the net worth required to get there is approximately $1.06 million as of 2025. That number sounds out of reach for most people, until you look at how the people who hit it actually got there. A Ramsey Solutions study of over 10,000 millionaires found that 79% received no inheritance whatsoever. Only 3% inherited $1 million or more. Most came from middle-class or lower-income backgrounds. The top 5 careers represented were engineers, accountants, teachers, managers, and attorneys, not hedge fund managers or tech founders. Teachers made the list. Here's the number that really challenges assumptions. Only 31% of millionaires in the study averaged $100,000 or more annually over their careers. 1/3 never earned 6 figures in a single working year. They reached millionaire status through consistency. 8 out of 10 invested in their company 401k. 3 out of 4 also invested outside of it. The average millionaire worked, saved, and invested for 28 years before crossing the $1 million threshold, with many not reaching it until around age 49. The path is longer and more gradual than viral success stories suggest, but it's documented, repeatable, and far more accessible than most people assume. The 10th statistic might be the most counterintuitive of all, especially for anyone obsessing over which investments to pick. When you're building wealth from scratch, your savings rate matters dramatically more than your investment returns. Consider 2 people, both earning $100,000 and both trying to reach $100,000 in savings. The first saves 10% a year, but earns only a 1% return. The second saves just 5%, but earns a 10% return, 10 times higher. Most people assume the second person wins easily, but the first person reaches $100,000 in roughly 9.6 years, while the second takes 11.7 years. Better returns, worse outcome. As balances grow larger, returns become increasingly important. A 1% difference on $500,000 is a very different thing than a 1% difference on $10,000. But for anyone in the early stages of building wealth, the implication is clear. Focus on what you can control. Your savings rate is within your control. Market returns are not. These 10 statistics paint a consistent picture of where most Americans stand financially in 2026. And more importantly, they reveal exactly where the gaps are. Nearly every statistic represents an opportunity to be on the right side of the number. The people who get there aren't extraordinary. They're just consistent. They spend less than they earn, invest regularly, avoid compounding debt, and stay patient through the uncomfortable stretches. That's always been the path. It still is.